Hello everyone, welcome back. As of now, if there is any question with respect to the previous topic we have already discussed, you can let me know so that we will be looking into the previous aspect, and in today's session we'll be looking into the next part of our syllabus area, the next question of our exam, which is related to the ethical issues, most probably, and with related to specific implications, or with related to specific scenario given in the exam. If any question with respect to the previous section, you can tell me. Otherwise, I'm going to start at with today's topic, which is related to the ethical issues related to any question. How to remember the exams? Only thing you can remember or remind those those standards, was the main idea was basically to get a in-depth understanding, and you need to understand what was the logic behind why any item or any standard was applied to a specific situation and why this is so that's the main idea of understanding the main concept of the standard, the main theme of the standard. And once you understand the main theme, it's pretty much understandable for everyone, pretty much easy for everyone to recall those standards. So that's the main idea, what I believe. COVID-19 implications. COVID-19 implication, just giving a short brief about how these accounting implications of the impact of COVID-19. This is basically a document provided by PwC, Ferguson's. So I'm just excluding this specific impact, that what happens with the local economy of our country I belong, but I'm looking into how it's actually impacting the businesses globally, the COVID-19 impact. And as far as we are ACCA students, being an ACCA individual, no one will be tested to a specific economic situation. The exam scenario must be based on a generic idea. So the very first thing that comes under is there could be some situation where the examiner might be asking you if you need to identify if there is an impairment on an asset or not. So for that specific situation, examiner might be giving you certain situations, like examiner is going to ask you that there's an airline industry, and due to the COVID-19 impact, which might go prolonged, and there is a specific restriction on the you can say on the airline industry for a longer period of time, and due to the closure of international borders, it might be possible that the airline industry is not going to be operational on a full-fledged operations for a certain longer period of time compared to any other industry. So that's the main idea to understand. So how this has impacted the overall business of any airline industry. Suppose it's an XYZ airline industry. So once you have understood the impact, now you will be looking into it, how the impairment could be tested. So examiner might be giving you an indicator of impairment. One of the major indicator of impairment is COVID-19. But as COVID-19 is gradually recovering and is reducing, and across globe, COVID-19 impact was reducing with the passage of time, but the impact on overall on the economy is not reduced. For example, interest rates have been declined across globe, right? So if the interest rate was declining, then if you are going to calculate the recoverable amount of an asset, and the recoverable amount of an asset, of specific asset, was actually calculated or previously calculated based on the value and use of that asset. And you know, value of use should be calculated. I'm just going to show you an example of IAS 36. So I hope that's something you can better understand. So IAS 36. So whenever there is an impairment on any specific asset, you need to understand how this impairment should be recognized. So this impairment should be recognized whenever there is an indicator of impairment. If I'm going to discuss very quickly, recognition criteria for impairment should be, there must be an indicator of impairment. You have to run an impairment test. If as a result of impairment test, recoverable amount is lower compared to the carrying value, then you have to recognize an impairment loss. So that's the main idea. Next thing is few of the asset. That is something IAS 36 specifically required. The few of the assets, irrespective of indicator of impairment, must be reviewed for an impairment test on annual basis. That includes, first one is the goodwill, second one is intangible asset having indefinite useful life, and third one is intangible asset which was under development process, which was not completed yet, right? So these are the three specific assets for which, irrespective of an indicator of impairment, you have to run an impairment test on annual basis. So what are the indicator of impairments? I'll be discussing about decline in market value, significant changes that have adverse effect on the entity, there's technological advancements, economic or legal changes, market perceptions, bad publicity, increase in market interest rate. That is an external indicator of impairment. So your question would be how increase in market interest rate or a decrease in market interest rate might have impacted the impairment or a reversal of impairment. So looking into this, if you are going to calculate value in use, so value in use is basically based on the projections, the future projections or the future inflows related to a specific asset. So if the cash inflows or outflows related to some future years, like in the next 2 years, 3 years or 4 years, you have to calculate the present value. You have to calculate the present value of those amounts, and the present value should be calculated using a discount factor, right? And that discount factor is most probably impacted by the market interest rates. So that's how your that impact the impairment of any asset. So that could be one thing. So that could be one idea where you can look into the impairment impact of any item. So that's something examiner is going to ask you. So this is first thing we have looked into the impairment test of financial instrument. Sorry, on any non-financial asset or any asset on which IAS 36 should be applied. So if you're looking into the financial instruments, it could be possible that classification of assets have been changed. Any debt instrument which was actually meeting the criteria of amortized cost or classification criteria of amortized cost, but due to this crunch in the economy, company or organization or a business needs cash flows, those should be released from those financial assets, and then company might have changed its intention of holding that debt instrument till maturity. Rather, the company has now planned to sell this debt instrument in the near future, either for trading purposes or looking for another better investment opportunity. So you have to reclassify those financial instruments based on the COVID-19 impact. Expected credit losses, this as there is a shrink within the economy that have impacted all the businesses. So the cash flow problems with all the businesses might have hampered the ability of a company to pay out its debts. Okay, or the contractual payments you have committed to pay on the debts. So it might be possible that the company might have missed few of the payments, and everyone know that this pandemic goes around like for around 5 months, and the lockdown started in the start of, I believe, in the start of January in this year, and till now there are few of the localities within the globe where still a partial lockdown is still going on. So it is possible that such businesses might not, any business that have issued a debt instrument might not be in a position to pay off its debt. And as the credit risk of that specific instrument have been increased, so we need to record an impairment loss on that specific asset. So it is also an indicator of impairment which have increased the credit risk of significant increase in credit risk of specific instrument. So that's how the examiner is going to ask you. Next thing is fair valuation measurement. If any financial instrument that was held at fair value through profit and loss or fair value through other comprehensive income, so the fair value might be drastically impacted due to changes, due to the impact of COVID-19 across globe. So a huge decline in fair value of those instruments have adversely impacted the financial performance of a company, and the company might have to disclose those decline in fair value measurements, right, in fair valuations. So that's another idea of how examiner is going to ask you the question. Modification of financial assets and liabilities, in the same way COVID-19 might have impacted few of the financial assets or liabilities, to which you need to now recognize those financial assets or liabilities in any other category. Revenue recognition criteria, leases, you might have rescheduled your leases. There could be, this COVID-19 might have impacted the going concern of many businesses. Now, if the going concern was impacted for a business, now company or a business is not able to provide the financial statement on a going concern basis. Now, the business have to provide its financial statement on breakup basis. Breakup basis means that the company have to report all its liabilities, all its assets at its fair value, or at the price which could be received by selling the asset, and that is required to be paid by an entity to settle all the liabilities. Are you getting the point? So that's the main idea of going concern impact. And any other financial reporting consideration, you have way much detail provided in this document. It will giving you some insight into it, how this could be tested. Well, for example, there is something examiner has in this document, it's already mentioned, goodwill or intangible asset might have an adverse impact, or you might have an idea. Remesdev, I think, is a new vaccine that was launched by some US company, Gilead Sciences. So that vaccine is still in a process of launch, and that's not giving you the result what was expected of that specific vaccine. So that might have impacted the intangible asset for that specific company, Gilead Sciences, that any investment or any development expenditure that the Gilead Sciences have already capitalized, that might have to be charged to the profit and loss account. So that's another situation that could be accounted for. Okay, so this is how the exam. There are multiple other situations those could arises with respect to this, but you have to make sure that you are applying the standards. Rather, you are giving some hypothetical discussions. You have to apply the standard if as per the requirement of the scenario, as per the situation explained within the scenario, impacted the implication of the standard, then you have to give your suggestion how those impact should be accounted for within the financial statements for that specific standard. I hope it gives you a better idea about it, but still, if you guys have any confusion, to let me know. I'll be discussing it if we got time, but I'm quite sure this type of question could be tested either in current issue section or the ethical issue section. So either in section A, question number 2, or section B, question number 1. So that's something examiner can test this COVID-19 situation within the exam. But that's not 100% sure. It's depending upon the situation how examiner is going to test such situation within the exam. So if there is still any confusion, then you can, if you have a specific situation with you and you came across a situation, you can ask the question. I'll be giving you an insight into it, how those specific situation will be impacted, because there are many situations, not just one. You can see here there are a lot many standards those are impacted with the impact of just COVID-19. For example, you have to create certain provisions because you might not be able to fulfill any committed contracts within that lockdown time period, within that that lockdown due to COVID-19 impact, and you might have to face some penalties against it. Or if someone customer went against you within the court and he is going to claim some sort of damages for not fulfilling a specific contract, irrespective that was due to the impact of COVID-19, but it's all depending upon the court situation. If and only if your legal advisor is in a position to protect you or to defend you from such claims due to the events which are not within your control, and that's why you might default on that specific contract. In that situation, you're not supposed to create a provision, right? But if your legal advisor is giving you an advice that this situation might not be as a result of specifically as a result of COVID-19, and you might have to pay some penalties, and you need to calculate the probabilities of those penalties, and if the penalty payment was probable, then you have to recognize a provision, a provision with respect to that specific contract. It could be possible you have entered into a contract which was a profitable contract before COVID-19 situation, but as adverse changes within the economy, the prices of the items or prices of the raw material or price of the commodities has gone way up, so that might have impacted the on-base contracts adversely, and you might have those profitable contracts now become the loss-making contracts, and now you have to recognize any loss that could be arises over the lifetime of that project immediately within your financial statement as provision, right? So that's the impact, and this impact could go on and on. Fair value of instrument can be impacted due to negative impact or negative interest of the investor. Most of the investors are reluctant to invest within the market. So fair value is basically assigned by the investor. If there are multiple investors within the market, those are willing to purchase a financial instrument or from the market, so they're willing to invest into it. So the market value of that instrument would become higher because demand was higher compared to, this is economics concept. As the demand of that instrument goes higher while the supply of that instrument was lower, so it could be possible that the price of such instrument was a bit more higher compared to, everyone is willing to invest into a document which gives higher returns compared to the rest of the market. So the price of that instrument went up, but as in COVID-19, every investor is reluctant to make further investments. So that have adversely impacted the fair values of those instruments. If you have listened about it, even you can see even in this document, the securities, the stock exchange Pakistan has declined with this 100. This and index has shed more than 27% from December 2019. There is decline of 27% in the trading within even just in Pakistan Stock Exchange, and you can look into this impact across globe, right? So the fair value automatically have declined due to the adverse movement within the stock exchange. I have just discussed COVID-19 impact on IFRS 15, and that was basically due to that could result any profitable contract into an onerous contract, into a loss-making contract. So you have to account it for accordingly. Just as a result of those, what should I say? As a result of COVID-19 situation. Current issues and framework or analysis. Now we are going to discuss. We have already discussing the framework within the different standards, how the framework has impacted the accounting within specific standards. Current issues would be discussed tomorrow, and today we are going to discuss ethical issues, and analysis would also be discussed by tomorrow, I believe. Hopefully, if we are done with this question today, we'll be looking into the current issues question within in today's session. So this is the question related to current issues, and this question is basically related to the ethical implications of any accounting treatment that were done by the company, by the management of the company. Yes, we need to create provision, but it's purely depending upon the advice of your legal advisor or legal person who is involved, or a lawyer, you can say, right? The lawyer will the lawyer is giving you the best advice. The expert opinion giver, he can better provide you an idea about how much penalties you might be in a position to pay off as a result of this COVID-19 situation, and you might not be able to complete any future projects or any commitments, right? But even in courts, if you went into the courts, the examiner might give you a situation where, due to the factors, those are not within the control of the entity, those are out of the control of the entity, hence the court might give a benefit of this this situation to the provider of the services, or to that party who actually defaulted on its commitments. It could be possible, and you might not have to pay any obligations or any liabilities against such miscommitments. Are you getting the point? So it's all depending upon the scenario given by the examiner. So we cannot hypothetically assume over here that in every situation you are supposed to create a provision. No, that's not the case. We need to look into the scenario, the comments added by the examiner, how the examiner is thinking of it, what examiner has given you in a situation, if that is impacting the business adversely, and if there are probable chances that the court is going to give the damages to the claimant, the party who is claiming the damages, then you have to record a provision, because you are the person who is going to pay off those damages, right? So that's the situation. It's depending upon situation to situation. It's not 100% sure that always you are looking into what should I say, you're always considering that any miscommitment results into provision. No, that's not the case. It depends upon situations. If court held you liable, then you are supposed to pay off those provisions, those liabilities in future, and you have to recognize the provision right now. But if court is of the opinion that it's not your fault, it's beyond your control, so as it's not within your control, so you're not liable for the payment of any liability, right? Give me 1 second. There is one more question. I have actually an explanation over here. So impairment test, when you are going to recognize an impairment test, whenever there is an indicator of an impairment, it could be an external indicator, it could be an internal indicator. Indicator is something that give you an idea that this asset is no more equals to its carrying value, or its current value, its market value, its recoverable amount is much lower compared to what is the carrying value of that asset. Now, first thing always comes first. I think I have a situation over here. IS 36 always explain that you have to calculate the impairment on individual assets in priority, right? You have to calculate impairment of an individual asset on priority. But in case if you are not in a position to calculate the impairment of individual asset, which means this individual asset cannot be valued, you cannot assign any cash flows to that specific individual asset, or this individual asset is not capable of generating cash inflows. This asset is capable of generating cash flows in combination with other assets, as a group of assets. In that case, you have to calculate impairment of a cash generating unit. Even in cash generating unit, you have to charge impairment to goodwill first. Then you have to make sure that if there is any asset that is equal, that's carrying value is equal or lower than its recoverable amount, then you have to exclude that specific asset from impairment. Any rest of assets for which you cannot have a reasonable estimate whether those assets were impaired or not, you have to charge impairment on pro rata basis or proportionate basis on remaining assets, right? But when you are looking into the impairment should always be charged to individual asset in priority, right? Only in case when you are not able to find out what is the recoverable amount of that specific asset. For example, you might not be able to calculate the NRV of that individual asset, Or you might not be able to find out value in use of that specific asset on individual basis, because that asset is not capable of generating cash flows on individual basis. For example, we have a production department, we have an assembly department, we can say we have a yes, we have a production department, we have an assembly department, and we have a finishing department. We have 3 departments total, and we thought that our assembly department might have been impaired, but as we cannot find out the value in use of this assembly department standalone, so we have to calculate what is the value in use of the whole department as a whole. For example, first one, the production department, the assembly department, and the finishing department. If you're looking into automobile industry, the production department actually completes the spare parts, the parts of the car, of the automobile, and assembly department is actually assembling all the parts together, and then the finishing department completes the finishing of the product of the vehicle, of the automobile. For example, the painting of the vehicle, or any other aspects, including polishing and including all other aspects. So if you are looking into it, that you need to find out what is the value and use of just assembly department. Do you think that without the involvement of production department, or without the involvement of finishing department, can you sell the product provided, or product which was produced by, or product which was output of an assembly department can be sold into the market? It's not possible. So for us, it's not possible to find out what is the impairment of that assembly department on individual basis. So we have to calculate impairment as a whole on the complete cash generating unit, right? Everyone told me I'm going to share this Excel sheet with you, but in the very last day, tomorrow, and I'm going to share specific standards with you, rather sharing all the standard, because in this Excel sheet there's a way much detailed available that I believe is not required to all of you. So I'm going to share the major portions of major chunks of this Excel sheet tomorrow, right? Can you please explain the exception component alone again? Exception component, I don't understand. Exception component means what? Okay, this exception, oh sorry, apologies, I got the point. This exception means that any asset that is at its recoverable amount, or its carrying value is lower to its recoverable amount. It could be possible that within a cash generating unit there are certain assets, those have more recoverable, those are at its recoverable amount. So you're not supposed to impair those assets. Those assets can recover the carrying amounts which we have assigned to those assets. So in that case, you're not going to charge impairment to those assets within the cash generating unit which have not shown any impairment, right? We are supposed to charge the impairment on rest of the assets to which you are not sure about it, whether they have impaired or not. One more question: if revaluation reserves specific to each asset, or it can be used for all assets collectively? I believe revaluation is specific to asset rather to collective assets. Those handouts should be available tomorrow to all of you from day 1 to day 5. I have actually uploaded the framework document as well, the conceptual framework 2018. So if you need that document, you can look into that specific item. Fine. So I hope we are done with most of the portions. So coming back to our question, because impairment was already included within these questions. I'm coming back to this question. Hudson had a year end of 31st December 2002 and operates a defined benefit scheme for all of its employees. So in this case, one thing that comes into your mind, that in this case we have to apply IAS 19 employer benefits to this specific scenario. So once we are reading out the whole scenario, we'll be looking into it, how IAS 19 provides us the guidelines, and then we'll be answering this specific question, right, based on the guideline provided within this scenario. In addition, the directors of Hudson are paid an annual bonus depending upon the earnings before interest, tax, depreciation, and amortization of Hudson Company. So there are two basic information given in this question. One is Hudson is a company that is operating a defined benefit scheme. And secondly, the directors of Hudson were paid an annual bonus depending upon the indicator that concludes earning before interest, tax, depreciation, and amortization. Hudson has been experiencing losses for a number of years, and its draft financial statements reflect a small loss for the current year of 10 million. On 1st May 2002, Hudson announced that it was restructuring and that it was going to close down a division Y. A number of redundancies were confirmed as part of this closure, with some of the staff being reallocated to other divisions within Hudson. The directors have approved the restructuring in a formal director meeting. Hudson is highly geared, and much of its debts is secured on covenants, which stipulate that a minimum level of net assets should be maintained. The directors are concerned that the compliance with the International Financial Reporting Standard (IFRS) could have a significant implications for their bonus and debt covenants. So you can see, even in this opening paragraph, examiner has given you a clear-cut indicator where you find out the ethical implications. The directors are concerned that if you are going to apply IFRS standards, International Financial Reporting Standards, in their own sense, in what they ask us to apply, then there could be a significant implications on their bonuses, a self-interest. Secondly, debt covenants, because if there is a breach of the covenants, then it is possible that company might went to liquidation, right? Because the debt holder might ask Hudson to pay off all the debts immediately in case of a breach of covenants. The conditions, those are mentioned against the acquisition of debts. Now, next scenario is about redundancies and settlement cost. This is, I believe, specific to the first scenario within the question, that is related to the company is running a defined benefit scheme or employees related cost. So Hudson still require a number of staff to operate division Y. Right now, they have planned to close down Y department, but closure is not going to be done on immediate basis or out of sudden. Closure might took a certain time period to get it closed. So that's why Hudson required a number of staff, those are working within the Y department, to work for the department till the closure in early 2003, right? As a consequences, Hudson offered its staff 2 settlement packages in relation to the curtailment of the defined benefit scheme. So there is a curtailment in defined benefit scheme. I'll be looking into the standard again, but right now I'm just going through the standard. I'm going through the scenario, and I'm showing you what are the important aspects. First thing, it's going to close Hudson, but it would take a lot of time, and it would be going to close in early 2003. And as a consequence of this, there are settlement packages provided by the Hudson company in relation to the curtailment of the defined benefit schemes for those employees who are going to leave the company due to the closure of this Y department. A basic settlement was offered for all the staff who leave before the final closure of the division Y. So company has offered all the staff before the final closure that if they leave before the final closure to pursue some other job, so they will be given a settlement based on their defined benefit scheme. An additional pension contribution was offered to staff who remained in employment until the final closure of the Y department or the Y division. There is additional contribution committed to those employees who will remain within the employment until the division Y closed. So that's a benefit given to those employees who will remain with the organization, so that if they are losing their interest, if they are losing the new opportunities, they'll be gaining something because they are contributing towards the closure of that Y department, and that helps out, actually helps out the smooth closure of this division. So the company has committed to pay them something extra as a additional pension contribution, right? So there are two basic things. Those are provided by the Hudson company to those employees who are working in Y department. The directors of Hudson have also only included adjustment in the financial statement for those staff who left prior to 31st December 2002. The director of Hudson have only included an adjustment. The only adjustment with respect to these two commitments was related to the the payments they have made to those employees who left the company, who left the Y department before 31st December 2002. The director have included, and what they have done with this adjustment, with the payment they have paid to those employees who left the organization, the directors have included this adjustment within the remeasurement component of defined benefit contribution scheme. They do not wish to provide any other settlement contribution until employment is finally terminated, arguing that an obligation would only arise once the staff were made redundant, right? On final termination, the directors intended to include the remaining basic settlement and additional pension contribution within the remeasurement component. So once the final termination was done in early 2003, the management has planned to again record those termination payments within the remeasurement component. The directors and accountants are aware that the proposed treatment does not conform to IFRS standards. So even directors are aware of it, that these proposed treatments are not in confirmation with the International Financial Reporting Standard, but the director believe that the proposed treatment is just and it will help Hudson to maintain its debt governance obligation and will therefore be in the best interest of their shareholders who are primary stakeholders. You can see here, directors are only considering the interest of one stakeholder or one section, that is the shareholders who they consider the primary stakeholders. Directors have indicated that should the accountant not agree with their accounting treatment, then he will be replaced. So there is another indication given by the directors of the company that whatever we say, it's correct. If you think, or if an accountant think the treatment is incorrect and he don't agree with the directors, then the directors have threatened them that that accountant is going to lose his job and he would be replaced by some other accountant who agree with the treatment proposed by the directors. Next situation is related to the tax losses. The directors of Hudson wish to recognize material deferred tax asset in relation to 250 million of the unused trading losses which were accumulated at 31st December 2002. So this section is with respect to IAS 12 taxation standards. So we'll be looking into two standards. One is IAS 19 employee benefits, and second one is IAS 12 taxation. Hudson has a budgeted profits of 80 million for the year ended 31st December 2002. Directors have forecasted that the profit will grow by 20% each year for the next 4 years. Hudson has budgeted profits of 80 million for the year ended 31st December 2003. You can see what is the profit of Hudson company to in 31st December. Hudson had been experiencing losses for a number of years, and till 31st December 2002, Hudson has made a small loss for the current year of 10 million. You can see here the company is currently making a loss, and the company is making loss from last many years, right? But in this case, the directors have planned out or have budgeted out or have a projection that the Hudson company is going to made a profit of 80 million for the year ended 31st December 2002. The directors have forecast that profits will grow by 20% each year for the next 4 years. So Hudson have another idea that the profit of this company will grow by 20% each year, right? We'll be looking into it whether this profit is going to increase or not. Second thing is, the market is currently depressed and sales order are at the lower level for the first quarter of 2002 than they were for the same period in any of the previous 5 years. There is one idea given by the examiner to you that this forecast or this projection provided by the director was incorrect. How you can say? It's explicitly mentioned within the scenario that the orders the company has received within the first quarter of 2003, the current year, for which the company or the directors have given a projection of 80 million of profit, even the orders were low. An order was much lower compared to the previous 5 years in which the company has already made a loss. So it is expected that directors of the company plan to manipulate the financial statements, right? So they are looking into it, how to reduce the impact of those redundancies and the impact of closure of restructuring of the company with relation to the bonus schemes and with relation to the other one aspect, that is the covenants on loan notes. Hudson operates under a tax jurisdiction which allows the trading losses to be only carried forward to a maximum of 2 years. You can see here, Hudson directors has wished to recognize a material deferred tax asset in relation to 50 million of the unused tax losses. If you can assume that company's projection or the Hudson or the projection provided by the directors was 80 million, within the next year, how much of the profits would increase? Within the next year, the profit increase would be, I'm just going to calculate it quickly to make sure we understand that how this is impacted, equals 80 multiplied by 120%. So the profit in the next year would be 96 million. And in 2003, just I'm giving you an idea that even with this calculation, directors are not adhering with the requirements of the standard. So in total, out of this 250 million, because only tax losses can be adjusted against the future profits for the next 2 years, for a maximum of 2 years. So if these are the 250 million losses, then I would say these 250 million losses are specifically related to the year ended 2000 and X2. So these tax losses can be carried forward to 2003 and 2004. Even then only 176 million of profit can be claimed. We're looking into the standard requirement and then we're moving to answer our question. But right now, this is the criteria. Even with on the basis of this calculation, the directors to recognize this material deferred tax asset is incorrect, right? So that's something we have to consider. These are the ethical issues with respect to these criteria. So one thing is, the first requirement is explain why the directors of Hudson are wrong to classify the basic settlement and additional pension contribution as part of remeasurement component. So if you know IAS 19 basic requirements, you can answer this question very easily, including an explanation of correct treatment for each of these items. Also explain how any other structuring cost should be accounted for, right? So there are 3 basic requirements. First one is related to the basic settlement, second one is related to the additional pension contributions, and third one is related to any other restructuring cost. So under IAS 37, it will give you the provisions, contingent assets and liability standard will give you a complete guidance how a restructuring, how a provision should be recorded as a result of restructuring plan of a company, right? So we need to look into 2 standards. First one is IAS 19 employee benefits and second one is IAS 37, right? In the next requirement, explain whether a deferred tax asset can be recognized in the financial statements of Hudson 31 December. So in this case, we need to account for IAS 12 taxation standard. And lastly, identify any ethical issues which arises from the director's proposed accounting treatment and behavior. So this answer could be done, could be completed easily if you have answered these 2, because this answer is 100% based on the answer of the above 2 requirements. So you need to be very careful. If you have answered the above 2 requirements, you can easily gain scores for this requirement, because the proposed treatment you have provided within the first 2 requirements will give you an ultimate idea how this is actually impacting the 2 basic things. Those were explained within this question. What were those? One is the bonuses paid to the employee, to the directors, the bonuses that were given to the directors, and second one is the covenants on loan notes, right? So with directors are always making sure that they are reducing the impact of this restructuring on their bonuses and on the debt covenant. So we need to identify how these have been impacted. So I'm first moving to IAS 19. And before this, I'll be just showing you what is the marking scheme for the first scenario. You have to apply the following discussion scenario. One is what should be included in the remeasurement component, or what items should be included in remeasurement component. If you had explained what items should be accounted for within the remeasurement component, you can gain 2 scores. Correct treatment of the basic component, how you can account for the basic component, that should be accounted for, that should account another 2 scores. And correct treatment of additional pension contribution, you can gain 2 more scores. And discussion of restructuring cost. So if you have understood the 2 standards, you can easily gain 8 marks with the help of understanding of the of IAS 19 and IAS 37. So moving back to IAS 19, I'm just explaining how IAS 19 is actually impacting, how IAS 19 is accounted for. So IAS 19 is basically related to pension plan obligations, right? So, sorry, IAS 19 is related to employee benefits. So employee benefits include many things: short-term benefits, termination benefits, other long-term benefits. Other long-term benefits includes long-term leaves, wages, illnesses, and post-employment benefits. So there are 4 basic items. Those should be provided within this scenario, that what items should be accounted for under these 2 criteria. Okay, one more thing. If you look into, I believe if you look into these 2 things, if I'm asking about how the pension remeasurement component. So first I'm going to explain the remeasurement component, then I'll be looking into rest of the things. So this post-employment benefit is actually related to any benefits provided to the employees after retirement, right? So termination benefits, you can say termination benefits are always recorded here, and they should be charged to the profit and loss account as an expense. And any other long-term benefits should be accounted for within post-employment benefits. And this post-employment benefit is basically divided into 2. One is defined contribution plan and defined benefit plan. Within defined contribution plan, any contribution made by the company should be charged to profit and loss account directly, and for this, no liability should be accounted for. The main focus of IAS 19 was basically related to defined benefit plans, in which the company has guaranteed its employees that they will be receiving this sum of pension at the end of their employment with this company, right? So in this case, the company has an obligation to pay off its debt. So pension plan obligation is one thing, and the fair value of pension plan assets we have already discussed in the previous sessions. Future obligations, this relates to the future obligation. It has a very complex calculation which was done by an actuarist, and actuarists use many other models like life expectancy, increase in salaries, wage rates, and multiple other things based on which the actuarist is going to calculate what is the pension plan obligation. Being an accountant, it's not our job to find out what was the pension plan obligation. It is the job of actuarist, and within your exam section, you're always provided with what is the pension plan obligation. So examiner is not going to ask you what is a pension plan obligation or how you're going to calculate the pension plan obligation. This is not our job. We are accountants, we are not actuarists. Second, fair value of pension plan assets. This will always be given to you within the exam, and you're not supposed to calculate the fair value of any pension plan asset, because this was maintained by a pension plan fund manager, and the pension plan fund manager is going to give you the value or the fair value of pension plan assets. So if you're going to net it off, you'll be finding out net pension plan assets or obligations. So IAS 19 defined benefit pension plan calculation starts with this net pension plan assets or obligation. If it is a net pension plan obligation, then you have to increase this net pension plan obligation with the interest expense component. This interest expense will increase the obligation. You are going to charge interest to the profit and loss account. Now, why you are charging that interest? Because you have calculated this obligation. You have calculated the present value of these future obligations as a pension plan obligation. Actually, has provided you a value which is actually the present value of all the future obligation using a discount factor, right? And you have invested within the pension plan assets. So You have to unwind this pension plan asset. So unwinding always works with the interest component. So you're charging interest, and this interest, as you have not paid for this interest, so this interest is ultimately increasing the pension plan obligation. Another thing is service cost component. This service cost component constitutes two things. One is the current service cost component, and second one is the past service cost component. Current service cost component includes any amount that have been increased due to the current year implications, right? Past service cost component includes any commitment that the employer has committed to an employee in the previous years, and those commitments have been revised within the current year. So past service cost component includes one, curtailment, reduction in past benefits, those are already committed by the employer. The employer might have increased if the company has decided to enhance the past commitment benefits, so this could increase, and this the past service benefits, so this could increase the past service cost components. Next was the settlement. Settlement is something that company has paid to the employees within the current year to those employees who have already left the job. Right now, within these three situations, you can easily identify the other two aspects that I'm going to explain later on. Then there is a contribution in the plan. A contribution is the plan if there is any item short, if the obligation gets short, and these pension plan assets are not making much returns to pay off, to account for the increase in the obligations. The company have to contribute some amounts within the plan. So this is the actual cash flow paid by the company. Benefits paid, we have already discussed in the previous class, in the previous session, in tomorrow's and in yesterday's session, that benefit paid is something yes, this is something we have already discussed. Benefit paid is something, it has reduced the pension plan obligation, and it has also reduced the pension plan assets. So there is no impact on your obligation, the net pension plan obligation. It has no impact on pension plan obligation. Next thing is, you have to calculate the net pension plan obligation, which is the closing value, this closing net pension plan obligation. So how this closing net pension plan obligation works? This closing net pension plan obligation actually is based on the actuarial calculation. At the year end, you are again going to hire an actuarist who is going to provide you a closing value of your pension plan obligation, because during the year there might be some situation those have changed, and actuaries give you a different calculation, and actuaries might be giving you a different pension plan obligation, and you have few of the asset invested within the pension plan, and you have paid some of the contribution to the pension plan assets that might have increased the pension plan assets, and there could be some returns on these pension plan assets that might have increased those pension plan assets. So once you are making up these calculations, that opening value of pension plan obligation plus interest component, and you have to deduct any curtailments, or sorry, you have to add current service cost component, you have to deduct curtailments with respect to past service cost component, you have to add any increase in past commitments, past commitment of the employee, of the employer, and you have to deduct any settlement. Either you need to deduct it or you need to add it. Settlement means there is some obligation of an employer with respect to an employee. If an employee has left the job and he moved to the new employer, then you have to pay him off. You have to pay him off based on the current situation. It could be possible that you might have to pay the employee, individual employee, a higher amount compared to the obligation you have recorded against that individual within the current year, right? So if you have paid an additional amount against the obligation, so what is the debit? And I'm just looking into the settlement double entry. I'm just giving you an idea of settlement double entry. What would be the settlement double entry? You need to debit and credit something. You have paid cash to the employee on settlement. Suppose it's 1,000. The obligation you have recorded, pension plan obligation, you have calculated, you have recorded with respect to that employee was 900, right? How much extra you have paid? Because we have to balance out the double entry, we have to equal the debit and credits. So this additional 100 should be recorded as an additional expense. If this is an expense, that expense was paid out, and that if this settlement, additional settlement was paid, then this must be added in this obligation, because this have already increased the obligation, right? This obligation was increased, and then you are going to pay from the obligation. But if you have calculated an obligation of 1100, if you have an obligation already recorded of 1100 with respect to an employee, then you have an income with respect to that settlement. So that should have to be deducted from that obligation, because you have decreased, reduced the obligation effectively by 1100, but you have only paid 1000 against that 1100 obligation. That should be recorded as your income. Are you getting the point? Right? So this, how settlement actually works. Settlement should always be recorded in a net situation rather as a payment out of that pension plan obligations, right? So what is remeasurement component? That was the very first requirement of our question. If anyone has a question, I'll be looking to it. Handouts are the same as yesterday. Let me check. Let me check here. Let me check if those are the same handouts. Yes, no, only conceptual framework project summary was added. Let me upload the latest handouts. Give me a second. Give me a second. I'm going to update the latest handouts. Give me a second. I'll be uploading those handouts, and then I'll be coming back. Give me just a few minutes. Okay, handouts will be available to all of you within few minutes. And once those handouts will be uploaded in this section, I'll be updating you all. So the next thing over here, what is a remeasurement component? Remeasurement component is always a balancing figure. Like yesterday we have discussed foreign exchange gain losses, because the opening balances, opening obligation plus interest component plus current service cost component and plus or minus the past service cost component minus this contribution in the plan, minus this contribution in the plan is never equal to the net closing pension plan obligation. So you have to make some balancing figure over here, right? So this balancing figure should be reported. I believe I have mentioned this balancing figure should always be reported in other comprehensive income. This net interest component should be added to profit and loss account as an expense, as an employee expense. This service cost component, which includes both the current service cost component and the past service cost component, you can see here both of these to be added, and that totals up the service cost component. You can see here these are the 6 basic items that I am going to account for, right? So any item that was moved forward is something that's under the head of this thing. Service cost component conclude one current service cost component and second past service cost component. Past service cost component constitute 3 things, right? So current cost component and past service cost component, current service cost component and past service cost component should have to increase the expense. That is a normal practice, but it could be possible that past service cost component might have reduced, might have been deducted because of only this curtailment was happened during the year with respect to the past service cost component, right? So these should be added, and both of these two would constitute the service cost component, and this service cost component should be added to this net interest component. You can see opening balance, add net interest components, add service cost components, and then you have to deduct this contribution, this contribution in the plan. Once you have deducted this contribution in the plan, then the benefits paid would have no impact, we have already discussed. Then there is a closing pension plan obligation, but this is the balancing figure that should be accounted for, because all of these working should not equal the closing. We have some balancing figure. So these two, net interest component and service cost component, should be charged to profit and loss account. This contribution is actually reducing your obligation within the balance sheet, so it has no impact on profit and loss account. This contribution within the plan has just an impact of debit pension plan obligation and credit cash, so it has only impact on your balance sheet, rather any impact on profit and loss account. This remeasurement component should have an impact on other comprehensive income. So what is this remeasurement component? Remeasurement component is basically due to the assumptions made by the actuarist. The actuarist is going to make certain assumptions, right? And these assumptions might change over the period of time, right? So if those calculations have a different impact, because actuarists might have considered that your obligation should be discounted with a percentage of 10%, with a discount rate of 10%, and actuarists might consider the salaries of employees would have increased by 10% within the next year, while in current year, everyone, I'm quite sure, has an idea that salaries or benefits paid to the employees have neither increased by any of the government. Most of the government, I would say, most of the government has not increased the salaries of the employees. They might have reduced it, so they might have the salaries, those are static, those have not increased due to this COVID-19 impact, right? So in this case, the pension plan obligation might not have increased as expected by the actuarist. Secondly, you have invested in your pension plan assets based on the actuarist calculation, and it might be possible that your pension plan assets have not generated enough returns to pay off these obligations. So due to these two assumptions, only this remeasurement component would arise. And this, for this specific aspect, International Accounting Standard Board assumes or considered it that this remeasurement component could be eliminated over the time period once the pension plan benefit approaches at the end. So that's why IAS 19 suggested that this should not be charged to profit and loss account. This should be accounted for in other comprehensive income, so it don't have any impact on the profit of the company. Are you getting the point? Now create a link. Why directors have planned to conclude any payments made to the employees, whether it's any payment, any settlement given to the employees as remeasurement component, because they don't want to decrease the profits. They have a self-interest, because if they are going to decrease the profits, if they are going to charge an additional employee expense, that ultimately reduce the earnings before interest, tax, depreciation, and amortization. Are you getting the point? So that has a negative impact on their bonuses. Company has already making losses, and due to this restructuring, company has to incur some other expenses, due to which the loss might have increased way much compared to what is expected by the management. Are you getting the point? So that is going to adversely impact the profit before interest, tax, depreciation, and amortization of the company. So it has impacted the bonuses of those directors. So directors might have asked, or they have considered that they are not going to charge. They're going to charge, or they have suggested to charge any settlement which should be charged ultimately to profit and loss account, but they have planned to adjust this settlement within other components of equity. Is it clear to everyone, or you have any concern, any issue with this specific item, do let me know. Okay. Entry for curtailment is basically you are going to decrease employee expenses. You have to make a credit entry to employee expenses and you have to make a debit entry to the pension plan obligation. Benefit paid has no impact. I have already discussed yesterday this. Benefit paid had no impact. It means the benefit paid to the employee is against this pension plan obligation of the company, right? So suppose on 1st of January, company has a pension plan obligation of 10,000 and company has a fair value of pension plan as 90,000. So the difference is this net pension plan obligation is 10,000. Is it clear? Next thing, I'm looking into the next aspect. Next aspect is during the year till 31st of December, company has paid a pension plan obligation of 5,000. There's a total pension plan obligation of 100,000. Company has paid 5,000 for that pension plan obligation. Next thing is, as company has paid this pension plan obligation, so the company is not paying those pensions. Company is asking the pension plan manager who has these pension plan assets to pay the pension plan obligations. So if any employee approaches the companies and asks the companies, where is my pension? Company is referring that individual to go to that specific investment company or a pension company or insurance company or a bank who is actually maintaining the pension plan assets of that company, right? To go there and ask them, they are going to pay. So it means if the pension plan manager, the person who's actually maintaining your pension plan assets, is not maintained by the company itself, it's maintained by any third party. So you are referring your employee to go to that third party and claim your pension plans. So if that third party is paying out the pension to that specific employee, it will ultimately reduce the pension plan assets. Are you getting the point? So we have reduced the pension plan obligation and we have reduced the pension plan assets. So it means if there is no further change, if there is no other change to pension plan obligation and pension plan assets, it means at the end of this year, the pension plan obligation totals 95,000, 100,000 the opening balance. You have paid the obligation, so it effectively reduces the obligation by 5,000, resulting into 95,000. In the same way, once you have paid out of those pension plan assets, the 90,000 assets have reduced by 5,000 and you got a result of 85,000. Now what is the net pension plan obligation? It's 10,000 once again. So it has no impact on your net pension plan obligation. Are you getting the point? I hope it's pretty much clear. We have discussed it yesterday. Okay, I believe everyone is in a good situation. Yes, IFRS are also relevant. I believe I have shared a document with you guys tomorrow, which is examinable documents. Have you seen this examinable documents? I believe this is September 20 examinable documents. Now I think there are IFRICs, yes. But IFRICs are, I think these are, yes, IFRS statements, IFRS practice statements. Now they are not actually within that, but I believe those should be, because what is mentioned within IFRIC is an explanation of any confusion within the standard. So if you want to refer those IFRICs, it's fine. If you don't want to, I think it's not mandatory for everyone, but if you have time and if you can go through those IFRIC, then it's perfectly fine. Otherwise, I believe your tutor is going to explain you the different situations, how those IFRICs should be applicable, or how it's applicable to a specific situation. What IFRIC do actually? IFRIC is only explaining the technical issues, those you might not able to understand it, or there are certain situations those who refer to International Accounting Standard Board, that these are the situation and how we're going to account for within this specific standard. So International Accounting Standard Board is actually given explanation that's named as International Financial Reporting Interpretation Committees. That committee is actually interpreting the new situations. Those are referred by the accountants, those are working in a practical environment, to International Accounting Standard Board, and they are giving them the advice how those items should be accounted for. So I'm not saying that this is altogether irrelevant, and I'm not asking if they are altogether relevant. So within your textbook, you'll be getting enough knowledge about the application of standard. Yes, I believe recording should be uploaded on ACCA portal, most probably at the end of 5th day, so you can look into that topic as well. I think the documents have already been uploaded. Yes, documents have already been uploaded, these two questions. So you can refer those documents from there. Okay, now I'm just going to answer this first requirement, and then we're going to have a break, and then we'll be coming back. What do you mean by remeasurement component? So we have answered this remeasurement component. Remeasurement component is actually the difference based on actuarial calculation and the return on the pension plan assets, right? The actuaries might have taken the assumption of the life expectancy of the employees, might have taken certain assumption based on an increase in salaries of that employees, might have taken certain other assumptions. Those might not return exactly as the actuaries have calculated in its original calculation. Those might have changed due to the changes in circumstances, right? So that is one impact, and that should be recorded in other components of equity, other comprehensive income. Secondly, this remeasurement component also results due to the different return on the pension plan assets as expected by the company. So it's not possible that you are expecting that pension plan assets will be giving you a return of 10%, and actually those pension plan assets have given you a return of like 5%, right? So it's differentiation of the expectation compared to the actual results you are going to obtain. So this remeasurement component is something those should be recorded in other comprehensive income based on the differentiation in actual performance, or based on the assumption the actual performance of pension plan obligation and pension plan assets, right? So how you're going to account for the items those are mentioned within this statement, and we'll be looking into restructuring later on, but I'm going to suggest how those items which are mentioned in the exam, how we're going to account those for. So there are two things. Hudson still require number of staff to operate in division. So as a consequence, Hudson offer its staff 2 settlement packages in relation to the curtailments of its benefit scheme. First thing, there is a curtailment. This curtailment, even Hudson is going to charge, or the management of Hudson has announced, or directors have proposed to charge this curtailment to profit and loss account, and there is no further information provided for this curtailment. Obviously, as the department is going to be redundant, the redundancy should be made to this. So there could be some curtailment. Those curtailments should be profit and loss account, and we are not concerned about it. But a basic settlement was offered for all the staff who leave before the final closure of the division. So there is one settlement. If there is a settlement, this settlement should be charged as an increase to pension plan obligation, and that should be charged directly to profit and loss account, right? So one thing is this basic settlement plan. This basic settlement plan should be charged to profit and loss account, and there is something, an additional pension plan contribution which was offered to staff who remained within employment until the final expiry. So there is an increase in pension plan obligation in a past service cost component, right? If there is an increase in past service cost component, then it should be assigned to the specific year to which it belongs, right? Till 31st December 2002, few of the portion belongs to this year, and the rest of the portion belongs to the next year, the 31st December 2003, because this should be applied to the period of time to which it belongs to, right? So some of the expense should be recorded with respect to this additional pension plan obligation within the year, and the rest of the additional or the rest of the additional pension contribution that should be provided to the employees in the next year should be recorded in up to the next year, within the next year financial statement, that is 31st December 2003. So these are we are going to divide the additional pension plan contribution into two main components. Now I'm going to explain you one more thing. If you are just going to explain that the basic settlement offered to all the staff should be accounted for as a settlement related to the past service cost component, this should be charged to profit and loss account, is perfectly fine. And the second, any additional benefit and the additional pension contribution that was offered to the remaining staff should also be charged to the profit and loss account. Why? Because it's an increase in pension plan in a past service cost component. So we have to make sure that this should also be charged to profit and loss account, rather charging it to other components of equity as suggested by the directors of the Hudson Company Private Limited. Is it right? Is it clear to everyone? Past service cost component, and there are few things those will also ask. So sustainable development was far more testable within SBL, right? Within SBR you will be asked a little bit of question with respect to this specific section, but I don't believe that there is enough knowledge to be testable with respect to sustainable development practice, right? So this is not the part of this, is a reporting paper. Second is differentiate between past and current service cost component. You need to understand past service cost component is always related to something you have committed in past, and you're either going to increase it or decrease it, right? What current service cost component is just based on the increment on your salaries within the year. Any employee got promotion within the year, so his pension is based on his, most of the time his pension, a pension of an employee is based on his last drawn salary. So if an employee got promoted within the current year, his salary had been increased, and effectively his last drawn salary would also be increased. So the current cost component is actually based on the changes made to the employee service during the year. Past service cost component includes anything that was already committed by the employer in the previous years, not within the current year. So the employer is going to change the past committed benefits to the employee, not just because of the current year, right? Next thing is the other part is, I hope this, if this is pretty, we will be looking into the answer as well. If this is clear to everyone, I'll be looking into the next portion. I'll be looking into the next portion, which was the other thing, restructuring costs. So I'll be moving to IAS 37 first. I'm going to identify what IAS 37 says, and then I'm going to apply the same requirements, the restructuring requirements to this case. We have this restructuring available here. So restructuring, when you are going to recognize the restructuring under IAS 37, IAS 37 recommends that there must be a true plan of restructuring available within the company, and the board of directors have approved that through this that true plan. So the restructuring could have to be concluded. But these two requirements does not commit that you are going to record the provision. The provision should only be recorded if that restructuring plan is communicated to those individuals which are affected, right? So in this scenario, if I'm going to look into it whether this restructuring plan is communicated to the employees or not, only based on that situation, I'm going to conclude that I'm going to record that provision. If you can see here, Hudson is experiencing losses. So Hudson has announced that it is going to restructure, and that it was, Hudson announced that it was restructuring and that it was going to close down a division line. it has actually announced mean it has actually communicated those employees who are going to be redundant. And you can see a number of redundancies were confirmed as a part of closure, with some staff being relocated to other division. So there are some of the staff those were relocated. The directors have approved the restructuring plan in a formal director meeting. This requirement was met. If we don't have a true plan, how the board of directors is going to approve it? So if the board of directors have approved that plan, it means there is a true plan. And secondly, it was communicated to all of those individuals who got affected. So it means you have to recognize a provision. But what provision should be recorded? What provision should be recognized? You need to make sure that the provision is only recognized based on those costs, or related to only those costs that was directly attributable to this restructuring plan. If any cost which could be incurred, which could be spent by Hudson company to maintain its, which is related to like ongoing activities, then in that case you're not going to create a provision with respect to those costs. For example, with the closure of that department, you have to retain some of the employees, or you have to relocate some of the employees. Such relocation cost or retraining cost should not be included within the calculation of provision. Are you getting the point? Because this is an ongoing activity. Irrespective, if all the employees of Y department are made redundant and company have to hire new employees, company have to retrain them and company have to relocate them. So any cost with respect to relocation or retraining, it's an ongoing activity of the business. So this should not be charged to for this specific cost, provision should not be created. Any marketing costs related to products, because of restructuring you have changed the product design and you need to market it. So irrespective, just because of restructuring you have changed the product design and you have to market it, so you can say this cost is associated with restructuring. No, marketing cost is an ongoing cost. It's an operating expenses. So it should not, for this you're not going to create a provision. Expenditure on new systems, profit and loss on disposal, or future operating losses, for all these activities you are not going to create any provision. So provision should be created for any redundancy payments, because if that department is going to close, only then you have to pay for the redundancies, and redundancies is an ongoing process of a business. Are you understanding? So anything that was directly associated, that was clearly associated with the restructuring plan, you have to record provision only for that specific item. Those activities which are only associated with the restructuring plan should only be included. So in this case, if there is any cost associated with relocation of staff, that the provision should not be constituted of it. Only any redundancy payments made to the employees, that should only be accounted for, and any other specific cost that is related to the closure of that department should only be concluded, and you have to provide the provision of such amount. You're not supposed to provide the provision for any rest of the amounts, right? I'm going to look into the answer to find out whether we have identified all the points, or we have missed few of the points. So I'm going to read out the answer. So this is the answer. Sorry. So this remeasurement companies is taken to other comprehensive income, and this comprises of actuarial gain or losses, such as the return on plan assets which differ from the expected return on the assets included within the net interest figure. Changes in the asset ceiling. Asset ceiling is what? Asset ceiling is different concept. If you want it, I'm going to explain it later on, but right now I'm not going to explain this one because we have short of time. Almost half of the time have been spent and we need to complete this question. Included with the net interest calculation, actuarial gain and losses are sometimes referred to as experience adjustment and rise due to the difference between the actual assumptions and which actually occur during the period. These will arise in instances such as unexpected movement in interest rates, unexpectedly high or low rates of employment turnover, or unexpected increase or decrease in wage growth. The redundancy will create an unusual high level of staff turnover, but this should not be treated as part of remeasurement component. The redundancy will cause the present value of the obligation arising from the defined benefit to decrease. This is classified as curtailment rather than as an experience adjustment to including within other components, other comprehensive income. So as it is a curtailment, so it should not be charged to other comprehensive income because it's not based on some assumptions or based on some estimates. It's something company has decided, and that is something due to the new decision made by the company. This curtailment has occurred. Now the next thing is we have to create a distinction need to be made between the basic settlement and additional pension contributions. The basic settlement is an obligation which Hudson has to pay as a compensation for terminating the employee service regardless of when the employees leave the entity. IS 19, employer benefits requires such payment to be recognized at the earlier when the plan of termination is announced and when the entity recognizes the associated restructuring cost associated with the closure of the Y department. Hudson should therefore have to provide in full for the cost of basic settlement regardless of whether the staff have left or not. This should be recognized as part of past service cost component in profit and loss account of Hudson for the year ended 31st December 2002. Is it clear? This should be recorded. Additional pension contribution is only paid to the employees who complete service up to the closure of fine. So for this additional pension contribution, as this was committed to only those employees who are going to complete their service until the closure of wine division. So company has to estimate how many employees would remain within the company until the closure of this division, and based on that estimate company has to calculate the additional pension contribution that should be charged to profit and loss account. Still that should be charged to profit and loss account because a short-term benefit. Since this is expected in early 2003, these should be accounted for as a short-term benefit. In effect, the contribution are in exchange for the period of service until redundancy. Hudson should estimate the number of employees who will remain with Hudson until the closure of mine. The cost of this payment should then be spread over the period of service, since this should be included within the current year cost components, and this will have an adverse impact on the profit or loss in both 2002 and 2003. Right? Next is the IS 37 criteria, and I believe this IS 37 criteria is what we have already discussed. In line with the criteria of recognition, any provision as set out in IS 37 provision, contingent liabilities and contingent assets, an obligation event and obligating event must have arisen from the restructuring provision and for the associated restructuring cost to be recognized. Furthermore, specific condition must exist for such an obligating event to have arisen in relation to restructuring provision. A detailed formal plan of restructuring is in place identifying certain criteria required by the accounting standard. A valid expectation has been created in those affected that the restructuring will be carried out either by stating to implement the plan or publicly announcing its main features. Are you getting the point? So these are the basic requirements of IS 37. Those are mentioned within the answer. In case Hudson had a valid expectation has been created because the restructuring plan have been announced, the redundancies have been confirmed, and the directors have approved the restructuring in a formal directors meeting. IS 37 specifically set out that the provision cannot be made where only a management or a board decision to restructure has been taken, as it is not considered that this is itself given rise to an obligation of restructuring. IS 37 also specifies that only the direct expenditure which is necessary as a result of restructuring can only be included in restructuring cost. This includes cost of what cost this should include: making of employees redundant, cost of terminating certain leases, other contracts directly as a result of restructuring. However, it is specifically excluded from cost of relocating, retraining staff, marketing or investment in many new system distribution networks, or these costs relate to the future operating losses and so do not fall under the definition of provisions. So thus the cost of ongoing activities such as relocating activities cannot be provided for. Is it clear to everyone what we have concluded here? I'm going to explain it, right? So we were going to have a 10 to 20 minutes breaks, and I'll be back after 20 minutes, and we'll be looking into the next two sections. We'll be looking into deferred tax, and I'm going to explain sealing at the end of this lecture, right? So I'll be back after 10 minutes. I'm not going to pause any screen. So you'll be looking into my screen if there are any changes, so that the problem we have created in one of our class should not happen again. So I'll be back like in 20 minutes, right? Okay, everyone, let's start. In this case, you are right that curtailment is actually related to the past assumptions, estimates, or the restructuring of the pension plan, which is maintained with the employer, which was committed by the company to the to its employees. It's always related to something you have done in the past. Second thing, due to redundancies or restructuring, it could be possible that there are certain settlements. Those settlements actually have either increased or decreased the pension plan obligation, right? So you are right in this case. Curtailment is actually related to the past commitments with respect to the pension plan, which was done by the company to its employees, and it's not related to the restructuring plan. It's basically if there is a restructuring plan and there are certain redundancies, for those redundancies, company have to pay some settlements. So though that comes under the head of settlements, right? Any other confusion with this regard? Okay, if not, then I'm looking into the deferred tax, the section B of this question. So before moving to the section D, deferred tax asset. So what is deferred tax asset? First, we are going to explain whether deferred tax asset can be recognized in financial statements of person in the year ended 31 December 2000 or not. So you can explain what deferred tax is, and then you can further explain rest of the things. So it's IAS 12. So if you're looking into deferred tax, unused tax losses, this is unused tax losses criteria. So if you're looking into unused tax losses, what amount should be recorded? In this case, first I'll be explaining what deferred tax actually means. So deferred tax is a difference of accounting rules and tax rules. Tax authorities have given you some different criteria, and the accounting provides a different criteria. So the difference of assets and liabilities under those two things is considered to be as a deferred tax. This arises on difference in accounting and tax rules, but these differences must be temporary in nature. So there could be two differences. One is a temporary difference and other one is permanent differences. Temporary differences constitute okay, we're discussing about permanent differences. Permanent differences are those differences for which accounting rules ask you, or accounting rules give you an idea or give you an authority to charge those items as either an expense or an asset. But tax authorities don't allow the businesses to charge such items as either as an expense within the profit and loss account, because tax authorities won't allow few of the items as reported as an expense in profit and loss account. So such items constitute the permanent differences. In this case, in example, I believe you guys might have read about in F6, any political donation made by a business is never allowed by tax authorities. Most of the tax authorities don't allow you to charge any political donation as an expense when you are preparing tax accounts. So that constitutes a permanent difference. When you're looking into the temporary differences are those differences which would be for the time being, and after certain time, after certain point of time, both of these two differences ultimately be equal. It means the value of an asset or a liability under tax rules and under the accounting rules would remain same after some point of time, a point of time in later. So those are known as temporary differences. So deferred tax only arises on temporary differences. What type of temporary differences are there? There are multiple others, and tax rules, tax authorities would provide you their certain examples. Those were available or those shared by the by IS 12. So with respect to this specific situation, we have unused tax losses. So how you're going to create a deferred tax asset or a deferred tax liability on unused tax losses? Okay, I don't think so. There is a WhatsApp group. If any one of you want to create it, then you can. As of now, I don't have any such. But if it is possible, might be I'm going to create it tomorrow, and then we'll be discussing anything within that group. Second thing is unused tax losses. In unused tax losses, the principle or thumb rule provided by accounting authorities is, in this case, tax authorities will allow to offset losses in one period against the future tax profits of the company for a limited number of periods. As in the case of Hudson, authorities only allow you to carry forward any losses against just the next 2 years, not any further years, just against the 2 years, right? So hence, in this case, deferred tax is based on the probability of the losses that can be settled against the future profits provided under the tax rules. So you need to be very careful. You can only create a deferred tax assets against the tax losses you have available, to which you think it's highly probable that you are going to create the profits in future periods, against which you can offset these losses, right? And we need to only consider those losses in the calculation which will only be claimed against the future profits. If you are not able to create any future profits, you're not in a position to generate any future profits, then you cannot claim any tax losses, you cannot claim any deferred tax, or you cannot create any deferred tax on such losses, right? This is a restriction provided by IS 12. How you can calculate it? Carrying value of expected losses, those will be probably claimed against the future profits multiplied by applicable tax rates, and such results is known as a deferred tax asset. If we look into it, 100,000 are the total losses of, for example, of a company, and it's highly probable that company is going to create or generate a profit of only 700,000, sorry, 70,000. So we can only create deferred tax asset against a value of 70,000, not against any other value. So the deferred tax, if the applicable tax rate is 30%, 21,000 is the deferred tax asset that should be recorded in books of accounts. Rather, creating a deferred tax asset of 30,000 on this 100,000 loss, you can only recognize 21,000 a deferred tax asset against all these such losses, but it must be based on a high probability that you are going to create future taxable profits only then. In case of Hudson, I'm just going back to this example. It's sure, I'll be creating tomorrow, and most probably I'll be sharing the WhatsApp link with you guys. Okay, let's complete this one. Directors of Hudson wish to recognize a material deferred tax asset in relation of 250 million of the unused tax losses which have been accumulated in 31 December 2002. So the company has an accumulated tax loss of, Hudson company has a tax loss of 250 million and the date of 31 December 2002. And the directors of the Hudson believe that we have to create a deferred tax of whatever the tax rate is. We have to create a deferred tax on the whole value of the loss of 250 million that was recognized till today. But the Hudson budgets, or the directors of the Hudson have estimated that the profit for the next year, that is 31 December 2006, would be 80 million, right? And the directors have the forecast that the profit will grow by 20% each of the next 4 years. Within the next 4 years, the profit will increase by 20% each year. But as far as tax losses are concerned right now, look into the assumption or the projections provided by the director. Is it valid or not? This our job. So looking into the market, it seems that market is really depressed and the sales order are at a very low level in 2003 first quarter, which were not even against which the orders in the previous 5 years was much higher for the same time period in which the company has made the losses. In case if you're looking to 31st December 2000 X2, the sales orders in the first quarter of 31st December 2003, in the first quarter of the year ended 31st December 2003, was much lower compared to the orders you have received for the year ended 31st December 2002. And in 31st December 2002, the Hudson company made a loss. So it is already expected that the expectation or the projections provided or the budgets provided by the Hudson company directors is invalid. And even the second projection that was the profit increase in profit of 20% for the next 4 years seems to be invalid. Why it seems to be invalid? Because due to a restructuring process, the company might have to incur some additional cost, additional expenses, and those additional expenses might have created some additional losses for the next 1 or 2 or more years, right? So it's not possible for Hudson company to return to the profits within the near future, right? Within next a year or more than a year. So if the company is going to, if the directors are asking you to create a deferred tax asset on the 250 million losses, value is invalid. Hence the accountants should be against the decision of the directors of creating deferred tax asset in such a situation, right? And along with it, Hudson company or the tax authorities or the tax jurisdiction in which Hudson operates only allowed to carry forward the trading losses for the next 2 years only, and not for the next many other years. So as far as this situation is concerned, it seems pretty much clear that this 250 million loss that was created till 31st December 2002, whose time period is going to be expired by the end of 31st December 2004. So it seems that company is not going to be profitable within the next 2 years, as 2003 seems to be very depressed year, and the company needs certain extraordinary efforts to convert those losses into the profit. So as far as 2003 is concerned, it doesn't seems to be that the company is going to be profitable in the year ended 31st December 2003. So the suggestion or the proposal provided by the directors of Hudson to create a deferred tax asset is invalid in this situation, and we cannot create a deferred tax asset as far as IS 12 is concerned or international financial reporting standards are concerned, right? So if there is any confusion till now related to deferred tax asset, do let me know. No, it's just 2 years. You can see here, someone has asked the limited number of years is of 5 years for carry forward losses. It's depending upon the tax jurisdiction. Like you might be asking about I can say you must be asking about your F6 F6 knowledge, and F6 is if you have studied UK taxation, then I'm not aware of the UK taxation system right now. It might have changed, the rules might have changed, but as far as my understanding is concerned, or what I recall from F6 is, yes, UK authorities provide you a 5 years time period to claim the tax losses, but not every jurisdiction is allowing you to carry forward losses for the next 5 years. It's depending upon jurisdiction to jurisdiction, because tax laws are provided by the local parliamentary authority or the local government, right? The local government of the local jurisdiction, rather providing by IFRS. IFRS is provided by International Accounting Standards Board, which is a professional body, and that can provide you how to account it for. And the accounting rules even differ from country to country, but there are just slight differences, right? Just because of the local customs, changes in local customs and local requirements, right? But as far as tax authorities are concerned, these tax rules are purely based on the local government, what they decide to. Yes, 5 years for UK tax, but this in the jurisdiction where Hudson is operating. We don't know whether this company is operating in UK or any other jurisdiction. So for this jurisdiction, Hudson operates under a tax jurisdiction which allows for the trading losses to be only carried forward for a maximum of 2 years, and here the limited time period for the tax carry forward losses just 2 years, not the 5 years. There is one more question. So in case Hudson is probable of making 80 million profit, then only 80 million multiplied by applicable tax rate will be taken as deferred tax asset. Yes, you are right. Not just 80 million. I have actually calculated within the Excel sheet, I believe. So it should be this 250 million can be claimed for the next 2 years, right? If the total loss within 31st December 2003 is 250 million, so we can only claim for in 2003 year end we can claim we can claim a carry forward tax loss of 80 million, and for the next year in 2004 we can claim, if the 20% increase in profits of Hudson is valid, then we can again claim 96 million out of the 250 million in the year ended 31st December 2004. So the total value would be 176 million rather 80 million. Is it clear? Okay. So I'm just looking into the answer. I'm just going through the answer, what answer is in this aspect. So this is a very detailed answer mentioned here. Next thing is deferred tax represents the amounts of income taxes payable or recoverable in future periods in respect of temporary differences. That's something we have defined what deferred tax represents actually. So temporary differences are differences between the carrying amount of asset or liability and its tax base, which is provided by the tax authorities. A deferred tax arises when the tax base of an asset exceeds the carrying amount. A deferred tax asset can only occur when the tax base of a liability differs from its carrying amount. This eventually settlement of this liability represents a future tax reduction in relation to the unused trading losses. The carrying amount is zero since the losses have not yet been recognized in financial statements of the Hudson. A potential deferred tax asset does arises, but the determination of the tax base is more problematic. The tax base of an asset is the amount which will be deducted against the taxable economic benefits from recovering the carrying amount of an asset. Where recovery of an asset will have no tax consequences, the tax base is equal to the carrying amount. So this whole paragraph, these whole first two paragraphs are just for the explanation of deferred tax, just how deferred tax should be accounted for. I'm just looking into the scoring scheme. An explanation of temporary differences and tax base, they constitute 3 marks. An application of above discussion on a scenario constitute 2 marks. You can see here. So if you have explained what deferred taxes actually means and how those deferred taxes should be, or temporary differences should be calculated, you can easily gain 3 marks. I believe even this discussion is something that give you around 3 marks easily. You can secure 3 marks with just this explanation. The next paragraph, which started from here, Hudson operates under tax jurisdiction which only allows tax losses to be carried forward for 2 years. You can see here, I'm not sure, just someone has asked the question. Even in the suggested answer, it's already mentioned. The maximum tax base is therefore equal to the amounts of unused tax losses for 2001 and 2002. Since these only are available to be deducted from the future profits, the tax base though needs to be restricted to the extent that there is a probability of sufficient future profits to offset the trading losses. The directors of Hudson should base their forecast of the future probability on a reasonable and supportable assumptions. there appears to be evidence that this is not the case. Hudson has recently history of trading losses, and there is a little evidence that there will be an improvement in the trading results within the next couple of years. The market is depressed, and sale orders for the first quarter 2003 are below levels in any of the previous 5 years. It is also likely that Hudson will incur various costs in relation to the restructuring, which would increase the losses into 2003 and possibly 2004. Only directly attributable expenses such as redundancies should be included within the provisions and expense in 2002, which would increase the current year loss as well, right? So even redundancies, those are made within 2002, should also increase the expense. Ongoing expenses may be incurred, such as retaining and relocating costs, but these should only be expensed from 2003. The forecast profitability for 2003 and subsequent growth rate therefore appeared to be unrealistically optimistic. Given that losses can only be carried forward for a maximum of 2 years, it is unlikely that any deferred tax arises, any deferred tax should be recognized. Is it clear to everyone how we are accounting for these tax losses? Yeah, exactly. T accounts working can be performed within the Excel file, right? So if you are going to perform some T accounts, like I'm just giving you an example, your scratch pad is more or less like the paint. So if I have a T account, I believe if I have a T account, I have this T account. If you have created a T account within the Excel file, you can copy that one and you can add that one into the paint in this way, right? So this is already available in your scratch pad. So if you want to perform your working on the scratch pad, so you can refer the working in this way. I hope it gives more sense to you how you can refer your working to the scratch pad. But if you're looking into the T accounts, you can easily perform those T accounts within the Excel, and then you can move those to, because copy paste always work within that scratch pad. So you can paste those items which you have calculated in Excel within the scratch pad. So I would recommend to use the scratch pad and try using those scratch pads if you are working in the practice environment, which we have discussed on the very first day of our presentation. And if you think that you might be looking into, you might not be able to perform some sort of discussion in practice session, you can perform using your paint option within your computer system, right? Okay. So we'll be looking into the next option, that is you are required to evaluate the performance of this company, the C option. So the C option is identify any ethical issues which arises from the director's proposed accounting treatment and behavior. You should also consider the implications for the accounting arising from the director's behavior. We have already discussed those impacts, and we are going to read out the answer truly. If there is any confusion, I'll be explaining those things, but your answer for this C section is actually based on the first two requirements answer what you have already done, right? So these two requirements actually give you an idea how you're going to answer it. So we'll be looking into it, how we answer. The director of Hudson are paid a bonus based upon earning before interest and tax, depreciation, amortization. It is possible therefore, despite the losses, that once these items are adjusted for, the directors may receive a bonus, right? The proposed treatment which was proposed by the directors, if you are adjusting those based on the director proposal, then these losses might be converted into profits. Then, which means a self-interest threat would arises. The directors have an incentive to manipulate the financial statement in order to try to minimize the losses and to maximize the profits. Directors have an ethical responsibility to produce financial statements which are fair, objective, and transparent record of the entity's affair. This is something the responsibility of accountants and directors should be when they're preparing the financial statement. There is an evidence that directors are willing to manipulate the financial statement in a way directly contrary to the ethical policies, integrity, and objectivity. It is likely that the net expense should be recognized for the termination of payments on an assumption that shares should exceed the reduction in present value of the obligation from the curtailment. If you can see this curtailment, the expense you have currently recognizing, and there is a curtailment provided by the company within the pension plan obligations, it is surely visible within the situation that this is the case that your curtailment or the payment you have made, the termination payments you are paying must exceeds the curtailment you have made to the pension plan obligation. So that should be reported in your profit and loss account. The directors are wishing to recognize this within other comprehensive income rather than profit and loss account, despite knowing it is contrary to international accounting standard. That's something they know already, and they are still suggesting to report any redundancy payments or payments within other comprehensive income. This would improve profitability, although it would not impact upon the net assets due to the corresponding decrease in equity. So that might have no impact on covenants, loan covenants, but that surely increase the profits of the company, which ultimately make the directors eligible for the bonuses. The director also have not recognized a restructuring provision. Now this restructuring provision must have reduced the net assets value. In terms being communicated to the staff, it is possible that this would treat as an exceptional cost and therefore would not impact on the bonus if that was treated as an exceptional cost. So exceptional cost would be excluded from the performance bonus calculation. If you can see in the question how the bonus are calculated, bonuses should be calculated depending upon the earning before interest, tax, depreciation, amortization, and it could be possible that there are some exceptional item, although exceptional items are not mentioned within the calculation. So as far as this suggested answer is concerned, I'm not very much concerned with this specific adjustment. The suggested answer said that if you are treating the termination cost, the restructuring cost, that would be considered as exceptional cost. So based on this exceptional cost, this should not be accounted for or not provided within your exam, that this is going to impact the, this is not going to impact the bonus. This is going to impact the bonus, right? Because earning before interest, tax, depreciation, amortization does not constitute the exceptional cost, right? So exceptional cost would also decrease the earning before interest, tax and depreciation of the company, hence it also impacts the bonus of the director. So you can mention that as well over here. It would therefore be useful to examine the precise terms of the contract in order to assess the potential impact on the bonuses. The treatment does, however, at least in the short term, help Hudson to improve the net assets position. That might have increased the net assets position. The deferred tax asset is based upon the forecast for too long period. For longer period, it is also based on unrealistic assumptions. Earning before interest, tax, depreciation, amortization will be overstated as a direct consequences. Net assets will also be overstated, helping Hudson to meet its debt covenants, right, on obligations. The director's explanation for their proposed treatment are not justified. So you know what was the director's proposed treatment, how they are going to justify it? They are justifying it because we are preparing the financial statement for the shareholders who are the primary stakeholders of the company. So even the primary stakeholders wants the fair and faithful representation of financial statements, rather a manipulated financial statement to give them an idea, yes, our company is going very good. You must be telling the shareholders, the main stakeholders, the primary stakeholders of the company, that your company is in real difficult situation. So if you want to sell your shareholdings within the company, so it's the best time you can sell it and you can quit the investment within the company. Are you getting the point? So their proposed treatment or their justification for proposed treatment is even not valid, right? So it will be interest for the company to be profitable to maintain net assets within the debt covenant stipulation. However, this should not be at the expense of credibility and transparency of financial statements. Deliberate manipulation of financial statement would reduce shareholders' confidence in the reliability of financial statements, and accountancy profession as a whole, the directors are deliberately floating international financial reporting standard to improve their bonuses and maintain debt covenant obligations. The director's action with regards to the account are contrary to the ethical principles of the professional behavior. It appears that directors have put the accountant under the undue pressure to falsify the financial statement to meet their own needs. And what that pressure was, the pressure was an intimidation threat arises from the directors, implying that accountants would lose their job should they not comply with the director's instructions, right? And this is how you can avoid the ethical issues. That's the paragraph that's really important. Whenever the examiner is going to ask you how you are going to avoid any ethical implications, and you represent yourself being a professional accountant, being an ethical accountant. So first thing is, you always need to discuss such things directly with the directors, those who have given you the instruction that this is not ethical, and as I am bound by ACCA code of ethics, I'm not going to perform such things which you have mentioned. Second thing, if directors won't agree with your suggestion, then you can move to someone else, a supervisory board like non-executive directors. If even directors are not in a position to listen to you, then you can ask help from ACCA ethical helpline for some sort of legal advice. And if you find out no situation, then it's far more better for you to be more ethical and to be more professional accountant, to maintain the credibility to this profession. You must consider resigning from this post, from this organization, from this job, seeking another employment elsewhere, right? So that's how this paragraph always comes in. Whenever you have some ethical issues, this paragraph always comes in, and you need to explain this paragraph for always, each and every situation. If still any confusion, it does create duplication, but it's not specific duplication. If you're looking into the specific duplication, I don't think so it's a specific duplication. It's something you have calculated something above, and now you are explaining it. What is the impact of the above adjustment on the profit before interest, tax, depreciation and amortization, that the bonus scheme, and how it impacts the covenants of the loan, right? If you are creating a provision, right, so your liabilities gone increase. A redundancy provision, if you are creating, that might have to increase the liabilities. But on the other hand, if there is any change within the asset, no. So ultimately the net assets have been reduced, is going to reduce. But as per the director's suggestion, there should be no increase, because they are not even recording any obligation. So the loan covenants would be maintained up to the level of the previous year, right? So in the above section, you have just provided what would be the best treatment under accounting principle. In C section, you are relating the above treatment to the two ethical criterions, those were mentioned within the question. One is the bonus scheme, and second one is the loan covenants, right? Any confusion right now? So it's not duplication at all. It's just a linkage of the first two answers with what I say, with the performance-based bonuses and the loan covenants, right? So this is how, whenever ethical issues comes in, you need to explain those ethical issues. I believe if there is no further question, we have half an hour. I think there is one question someone has asked for asset ceiling. I'm not sure if that is the case. I'll be discussing asset ceiling, and then we're moving on to an overview of the next question. And once we're done with the overview, we'll be looking into the detail of that question in the next class tomorrow. Remeasurement component in case of winding up of the company, recycle to profit and loss, or directly transferred to retained earning. What would be your expectation from this? I believe it should be directly transferred to the retained earning. It should not be moved to the profit and loss account. It should not be recycled to profit and loss account. It should be directly transferred to retained earning. That's what I understand. What was your answer? Yes, tomorrow is the last session. I'm not sure, someone has mentioned, can you please see my answer to a question and mark my answer? What was the question? What was the answer? I might missed, apologies. If you can ask the question again, let me look into it if if I can get the question. No. So if you can ask the question again. Hedge accounting, I would say yes, it's important. Yes, I'll be sharing the main portion of Excel file tomorrow. In tomorrow's session, you'll be getting the handouts of your Excel file, most probably in the form of PDF file. So, but tomorrow. Hedge accounting, I was answering hedge accounting. Hedge accounting, I believe, yes, it's important, but in your exam session, you might not be getting more than 5 to 7 marks with respect to hedge accounting within your course, within your examination. That's something my expectation is. That's not something the requirement of the examiner. Examiner has never restricted himself from not providing in hedge accounting. Examiner can provide a complete 30 marks question for hedge account with respect to hedge accounting. But I would recommend you guys, in this SBR syllabus, you are only supposed to do some sort of accounting for hedging purposes. You are not supposed to calculate what hedging actually is and how the hedging should work, because hedging topic is specifically allocated to P4 syllabus, the advanced financial management syllabus, rather to SBR syllabus. Are you getting the point? So that should be testable in F9, or sorry, P4, rather within the SBR syllabus. IFRS 15, IFRS 9. So we have half an hour. I'm just going through the asset ceiling quickly, and then I'll move into IFRS 9 to give you an understanding how IFRS 9. I'm quickly going through both of these two standards. I'm going to end the class, and then we'll be looking into the next two questions tomorrow, most probably. We have leasing related question tomorrow, but we'll be looking into that question tomorrow. Okay, it's IAS 19. So if you're looking into the asset ceiling, what asset ceiling actually means? Asset ceiling means that now we have this working downward. Let me check into the asset ceiling concept. So if your pension plan assets, this is the asset ceiling concept. So what is asset ceiling concept? I believe this is asset ceiling concept. Asset ceiling concept is a concept that might oftenly comes into the practical situation, because mostly in pension plan we will always find out a net obligation. What means net obligation? Net obligation means your pension plan obligation is always higher and your pension plan assets are always at a lower value. So ultimately company had find out a net pension plan obligation that the company had to pay into the you can say pay into the pension plan fund, into the pension plan fund manager, to the pension plan fund manager, to the additional amount company is required to deliver to the pension plan fund manager so that he can meet the future obligations. But there are few situations, few circumstances when pension plan asset would be higher compared to the pension plan obligation. So as a result, you find out net pension plan assets, right? Rather getting a net pension plan obligation, you will be finding out a net pension plan assets. So you have to apply the prudence concept. So what prudence concept is, which is mentioned in your framework? Don't overstate your asset and don't understate your liabilities. So as these assets, the pension plan assets, are held with the pension plan manager, you are not controlling those assets. So you'll be looking out what is the maximum benefit I am deriving out of those pension plan assets, the net pension plan asset, if that is the only amount. So we need to make sure whenever we need to find net pension plan assets, assign the value of net pension plan asset, whichever is lower. We have to assign the value to the net pension plan assets out of these two values, whichever is lower. Normal calculation of net assets of pension plan. So if you are calculating it, what is the net assets value of the pension plan obligation. So normal calculation is you have to calculate the difference between the present value of pension plan obligation and fair value of pension plan assets. Very simple calculation. You're going to calculate the fair value of pension plan assets. You need to deduct the present value of pension plan obligation, which is provided by an actuarist. So this is the simple calculation or the normal calculation. Second is how much benefit you can obtain in future from these pension plan obligations, from these pension plan assets. How much is the maximum benefit you can obtain from these net pension plan assets in future? So the benefit you're going to obtain could be either in a form of future, in the form of cash received by selling those net pension plan assets, the additional pension plan assets, you are going to sell it into the market, and the benefit you are going to receive, the cash you're going to receive. Or you might not want to sell the pension plan assets, and you plan it for that I have already paid it, and these pension plan assets would reduce my future contributions. So whatever is the cases, right? So whichever is lower, asset should not be overstated. You must have to calculate whatever is lower. If the normal calculation is lower, then you must consider this is something an asset ceiling is. Ceiling means this is the limit for you. You cannot move upward. This is the upper limit. This is the ceiling for you, and you will be restricted to this level, right? So if under the normal calculation, the value of pension plan assets is lower compared to the future benefits you're going to obtain either by selling the net pension plan assets or the additional pension plan assets, or the reduced payments you are paying against the future pension plan obligations, right? So whatever is lower, you have to calculate. So this is the asset ceiling concept. Still any confusion? I think you need to understand the basic concepts of an exposure draft. Rather learn those exposure draft by heart, you need to only understand what is the concept. This is a very good question. If we practice in the last 10 days, will it be enough? Like 6 to 7 past papers would be enough to pass? I have done very little practice. Frankly speaking, if you are involved in some practical life scenarios and you are involved in the application of accounting standard within your job role on daily basis, then I believe not exactly 10 days, but you can say 20 days is something a time, because you already have an understanding. You go through like more than 20-30 odd questions, and you have understood how you're going to answer the question within the specific exam scenario, then it would be okay. But if you have very little knowledge of accounting standard, I mean if you have the knowledge of F7 and you have done few of the past papers in last 10-12 days, so I don't think so it's going to guarantee you that you will be getting those paper done. So I'm not going to demotivate you. I'm just giving you an idea. You have a lot of time. Just go through your exam kit very quickly, and you go through your exam papers. And if you have any confusion or concern, take out your book and go through the standard and understand what standard is actually explaining to you, and then you will understand the requirement of the answer, and then you can answer it. Then it would be easier for you. Right now, I believe there are a lot many days you can go through it. I believe then yes, if it is, then yes, you can. Example of reduction in future contribution. Reduction in future contribution means whenever the obligation rises, whenever the pension plan, as the pension plan moves forward in the time period, then the pension plan obligation should have been increased, right? But you already have additional assets available, so you're not supposed to pay something in the within the pension plan in the form of contribution. Got that? So your contributions are reduced. So you can make simple calculation. You can calculate the present value of future contribution that you estimate or you expect you are not supposed to pay. I'll be sharing, I'll try my level best. I'll be sharing the exposure draft tomorrow with you guys. I think 1 or 2 of my students are in this session. I request you to remind me for the exposure drafts. Surely I'll be sharing those exposure drafts with you guys tomorrow. No, we are not going to ignore the extra value. We need to make sure which one of these extra value is lower based on this. So that should be reported as net pension plan assets within your asset section under the head of assets, non-current assets, right? Because most of the time net pension plan obligation should be reported under the head of liabilities. One more thing, if you can look into it, a framework provides a guidelines that assets and liabilities should not be netted off, but IAS 19 give you a guideline that pension plan assets and pension plan liabilities should always be reported as a net value in your books of accounts, rather reporting it separately under the head of assets or liabilities. Yes, you will be getting a ratio analysis question or any other financial performance indicator questions. Yes, under IFRS 9 you can also net off assets or liabilities, but only in case if assets or liabilities, if the assets or liabilities created were against a single contract and those should be settled at the same point in time in future. I believe most of the time direct method might not be testable, but I cannot guarantee you because it's all depending upon the examiner. It's mentioned in IAS 7. IAS 7 is whole testable. IAS 7 give you 2 methods for calculating the cash flows, either direct method or indirect method. So it's depending upon the examiner consent or examiners, depending upon the situation of examiner, what examiner expect of you. Important standard, most probably I would not say that there are any specific important standards, but I have already gone through few of the standards in this session which I think are important and which could be testable. I have already discussed. You can look into the free cash flows concept. I believe that's something, an important concept that might be testable in the exam. Free cash flows concept, you must be looking into it, what free cash flow means, and you must be looking into the details of free cash flows, right? IFRS 9 is another standard, but I believe IFRS 9 is the standard based on which a very smaller question would be asked. But yes, there could be a question with respect to IFRS 9. There could be a question. IAS 21 is something I think that it could be testable, and IAS 19 employee benefits is another standard that is, as far as my expectation is concerned, could be an important. IAS 36, IAS 16, those are the main standards. Those were most of the time tested by the examiner because these are the basic standards. This is something my understanding is, this is not a guess, so you need to be very careful. I'm not giving you any guess, any individual. This is just an idea that these are not just, you can say, important standard, because understanding of these standards will give you a better understanding of the rest of the standards. So that's something my idea is. IFRS 16 is also one of the standard that give you a better idea. If the lower in future benefit, then entry to reducing net defined benefit. So only this value should be recorded in your books of accounts. Very simple, right? And it would be reducing, it would be reversing any expense, any employee expense you have already recorded in your books of accounts. It's a reversal in your employee expenses, because once you are recording asset, there must be a credit entry in profit and loss account. So that credit entry actually impact a reduction in employment expenses. Yes, I will be sharing the main portions, the main chunks of the Excel file tomorrow. Okay, any other questions related to any other standard, do let me know. Yes, you need to break it down. You need to break it down. And that give you some additional professional scores if you are breaking down all the questions with respect to this ethical issues. But one thing, important thing, I'm giving you an idea how you can identify what is an ethical reporting. Ethical reporting, yeah, or ethical issues or ethics question, within the ethics question, only thing is, within the scenario, examiner is giving you an idea that directors or accountants or any other individual who is in a position to run the company is giving you or proposing you a treatment for certain item, for certain element of financial statement which is against the standard, right, for any of its own benefit. You need to explain what standard mentions, then you need to explain what is the impact, of that proposed treatment on his self-interest, right? So that's the main idea. So anywhere within SBR, you are supposed to apply accounting standards. You are supposed to apply accounting standards. Right? I hope I'm pretty much clear what I want to say. In the first three questions, it is always required that you must be explaining what is the implication of the standard, how the standard should be applied to a specific situation. That's your answer. Integrated reporting, yes, that is testable within your exam, but I might be sharing a document or related to integrated reporting. So I believe there is one of the student within the session. I'll be dropping a text after this session, at the end of the session, to my student that that's my student must recall me tomorrow. One is the exposure draft, second one is a document related to integrated reporting. You need to just go through the integrated reporting document to get an idea how integrated reporting should be answered within the exam scenario. But it's not the case that integrated reporting is thoroughly discussed within SBR syllabus. You might be receiving 5-7 marks because integrated reporting, this specific section must be accounted for. It is mainly accounted for under SBL. If anyone is studying SBL, he might be aware of it, that integrated reporting was mainly discussed under the head of under SBL syllabus. Like if we have net defined benefit asset amounting to ₹100, but future benefits are 80. So yes, no. So only 80 should be recorded as you can say as net asset, as net pension plan assets. This 80 should be reported, not 20. If 100 is the future benefit, if 100 is the value of net assets using this normal calculation, we are saying just 100 is based on normal calculation, and future benefit based on reduced contribution, which is 80. So the value you are going to assign to net pension plan should be 80. Now look into it. I'm just creating a T account for your understanding. I'm not sure who's this. So any individual who else is here, just to give you an understanding over here. You have net pension plan obligation and net pension plan assets. Give me a second. So this is your, oh sorry, give me a second. So this is your net pension plan asset / net pension plan obligation, right? So this could be, suppose the opening obligation was 35, right? During the closing would be 80. So what is the balancing figure that should be charged to profit and loss account? That balancing figure would be this 80 minus 35. So this 45 should be charged to profit and loss account as a reversal of sorry, no, I'm just in this closing balance should be this, sorry, this 80 should be the closing balance over here. So within your profit and loss account, the amount that you are going to report with is 115, a reversal of employee expense. Is it clear? Are you getting the point? But asset, pension plan asset should be recorded as 80 million. The successful development of the product is must. No, it's not the case. During the development process, you need to identify what are those criteria. Just giving you an idea. Most of the time, it's always mentioned within the question. I'm going to generate a question to a group tomorrow, and I'll be sharing the link of that group within this question answer group, so you guys can add that group. But I'll try to create a group. So what was the question? It's related to IAS 38 intangibles, right? So this is the criteria of intangible. Under intangible heads, okay, this is the criteria: research and development, right? Anything that was under the research head, it should be always charged to profit and loss account. So what research actually means? Research actually means a planned investigation. It's a planned investigation to gain new knowledge. You have never gained a new knowledge, or you have not developed a new product, or you have not gained any knowledge with the help of which you can develop advanced products or enhanced processes, right? So development phase is the phase in which you have gained the knowledge, and you are now working in a process to develop the advanced products or enhanced processes, right? That's the difference. So if you want to capitalize this development expenditure, you need to make sure you are meeting these 6 criteria, which is named as PIRATE. Probable that that this will result in inflow of economic benefit. Once the development expenditure was completed and you got an intangible that results into inflow of economic benefit, management has an intention to complete it. Cost associated with this development project is reliably measured, can be reliably measured. You have enough resources available to complete the project, and then it will provide you the results as expected, or the management has been capability of selling or using the asset, whatever the management wants to. It is estimated that project would be profitable. So these are technically feasible. It would give you the results as expected by the management, right? And the management can either sell it or use it. So these are the criteria if you want. If any of this criteria is not meeting, for example, a company is involved in a research project, right, where it is highly probable that it will result into inflow of economic benefit, management is committed to the development. This case, cost is liability measurement, but for the development is this project. I'm just giving you an example. This is just an example. So don't, for understanding purposes, it's not something you can quote to someone else. This is just for understanding purposes. For example, there is a scientist whose age is more than 90, and he is not within developed jurisdiction. That in scientist is within the underdeveloped countries, living within the underdeveloped countries. So you can well expect what is the life expectancy of an individual who's above 90 within underdeveloped countries. Might be he is going to expire within the very next day, right? So life expectancy in underdeveloped countries is way lower compared to the developed countries, right, due to the circumstances of these countries. But let's see, you have only one scientist available who has a know-how about this project, and you have no other scientist available. So all the criteria are met, all this PIRATE criteria is met, except this adequate resources, because if this scientist is going to expire within the next day, who is going to complete this project? So you cannot capitalize development criteria. If a single condition out of these 6 is not met, you cannot capitalize development of any expenditure that you have done on the development. You have to expense it out, and once the development expenditure is expensed out, it can never be capitalized later. Yes, you actually have the question within your handouts. I believe I have that, and I'll be explaining it to you tomorrow. There are 6 basic items. Those should be, let me explain. Under IS1, we have these 5 items. Revaluation surplus, these should never be recycled. Answer to the question, can you please show the list of other comprehensive items to be recycled and those will not be recycled? Revaluation surplus can never be recycled. Is it clear? Fair value through other comprehensive income gain losses can either be recycled or cannot be recycled, depending upon the financial instrument on which these fair value through other comprehensive income gain losses should arise. For example, if an equity instrument if any gain losses on equity instrument, those are reported in fair value in other comprehensive income, those should never be recycled. But in the same way, if any fair value gain losses, fair value gain losses, those are reported in other comprehensive income related to debt instrument, those could be recycled, right? So we have identified these 2. Foreign exchange gain losses on foreign operations should always be recycled. Should always be recycled. Cash flow hedges, any gain losses, those are reported on cash flow hedges. Those, depending upon the situation, if it's a fair value hedge, then it must be recycled. Is a cash flow hedge, then it is neither recycled nor non-recycled. It should be adjusted within the item you are requiring. If it's a non-financial item, it should be charged to that, it should be added within the value of that non-financial item, right? I'll be answering the next question. Just actuarial gain losses should, they will never be reported in, they should never be recycled into a profit and loss account. Actuarial gain losses will never be, right? So I hope this is clear to all of you. The last thing is share of associate or a share of other comprehensive income of associate. So yes, whenever you're going to dispose of the subsidiary, these should be reclassified to profit and loss account. If anyone does not meet, then okay, you are asking about tomorrow, so might be I'm creating a WhatsApp group, so you can coordinate with your friends who are part of this group. So I'll be sharing those documents within the WhatsApp group as well. Entity-based risk is always reported in other comprehensive income, or depending which method we are using for our financial instruments. Entity-based risk, I believe yes, entity-based risk is always charged to the comprehensive income. It should never be reported into profit and loss account. With respect to fair value to other comprehensive income instruments, which item will be recycled? These fair value through other comprehensive income gain losses, if created on debt instrument, it should be recycled. Foreign exchange gain losses on foreign appreciation should be recycled. Fair value cash flow hedges should be recycled. Clear? I hope it's clear. Rest of the things should not be recycled. I'll be sharing tomorrow. I'll be sharing the link of the group tomorrow, most probably. Done, guys. Thank you so very much for participation. It's really an awesome and interactive session. I really enjoyed it. So we'll be having the last session tomorrow, and I'll be looking into the last question I've already shared with you guys, which is with the name of question number 3.1, right, in your handouts. So you can download it from this section and you can go through that question, and we'll be discussing it tomorrow. Sure, I'll be. And thank you so very much. Nice meeting all. Bye.